Hey everyone, it's Imran from Options Insight. This is your macro options spotlight. Okay, markets rallying on Friday, finishing quite strongly on the back of China. So China reopening optimism really taking hold, stoking massive spikes in Chinese stocks. They were up 7.5% on the day, 10% plus on the week. Commodities were up a lot. We had copper up 7.5% just on the day. Massive move for copper. And that was finishing up a 2 sigma move on the week. So copper kind of breaking out of that sort of downtrend resistance that it was forming. Oil also having a great day, up 5, and even gold up 3%. Dollar having its worst day since 2015, down about 2% on the day. And funnily enough, health officials continue to deny that they will be removing zero COVID policies. But markets don't seem to care. The markets are trying to front run it. They're thinking even if it doesn't happen in the next month, it's coming because there's wind of the idea that they want to have a much more open economy by March next year. And so the markets are now going to try and front run that and look for where there's value in markets. And, clearly China's been beaten up for quite some time. So there arguably is some value in owning some of this stuff. And if they do reopen, then this has easily got another 20%, if not more, to re-rate higher. And that's the trade people are chasing after right now. If we look at implied volatilities, we can see, equities in the US and Europe down about a vol point, and that's even with on the week S&P being down 3 and a bit percent. So pretty horrendous performance for implied volatility in the US. Obviously, China vol was up pretty hard. It was up around 9 vols. That's actually a new high in that front end volatility, even though the market's going up this time. But just the wild swings continuing there in China. Also seeing a bit of a bid to oil and copper volatility, whilst we're seeing bond vols continuing to drift lower, along with FX rates outside of the dollar CNH. All the other FX is kind of drifting as well. If we look at the carry side of things, not a lot of green really to speak of. Generally, things moving around quite a lot as we get these sharp upside rallies. So copper seeing a minus 67 there. We're seeing cable still moving, euro moving quite a lot relative to their implied, because bear in mind that their implieds are looking a bit more normal in terms of FX, where you've got euro at around 11 vol and you've got cable around 13 vol. So these are looking more like FX vols, whereas they're still realizing as if they are stocks, where you've got cable at 22 and euro at 17 and a half. So some pretty decent value for the people who are long gamma in FX. Outside of that, we were seeing positive carry in European stocks. That's reduced, as has HYG, also reduced, but still managing to hold on to slight green. If we look at skew we've been mentioning has been getting sold, particularly in the S&P down to 2.75. So these are pretty extremes in terms of low levels of skew. But to be fair, vol has performed so badly on the way down, it's been the right trade to sell skew. Owning skew has been a horrible trade. I actually did own some myself and I dumped it last week. It's not been a lot of fun being long skew. One day it's going to come back, and it's going to come back with a vengeance. But right now, to own it is a pretty dangerous place to be right now. That's what it looks like. Oil skew, we've been mentioning, has been coming down. It's flipped into call premium. So you've got minus half a vol there, which means calls are trading about half a vol above puts and 25 delta 1 month space. Copper skew, on the other hand, despite the 7% rip and the move on China, copper skew remains for puts right now, 1.3 vols. That is not the case in things like silver. That is for calls. Gold's about neutral there, sitting at 0. But an interesting dynamic there where copper is still holding a bit of a bid for puts, I guess, because it's the most cyclical of those metals. But we'll talk about, we've got a trade idea for silver that we'll talk about, which is quite interesting. And then finally on the skew side, HYG skew bouncing off the lows. As vols got crushed, they're down to 13.5 now. So HYG vol resetting pretty hard there. And given that the skew had flattened a lot as well, maybe providing a bit of value in those downside puts. If you are bearish, picking up some HYG downside is starting to look interesting again. And that skew probably bouncing on the back of that. All right, that's the summary for today. Okay, now if we have a look at what else we're looking at, bear market seasonality. So it is certainly the case that there tends to be a positive seasonality into year end, right, for Q4 for stocks, especially on years where we have midterm elections. So generally, people have been talking about the positive seasonality setup for why we might not actually get a puke. We might actually get a rally into year end from here. And the Santa rally phenomenon is real. It's been around for years. I've traded it for many, many years. So it's something investors need to be aware of and cognizant of. However, if you examine markets a bit more closely and you look back historically and you filter for bear markets like the one we're in now, so markets that are down, 20%-ish or whatever up to this point in the year, and then you look at the seasonality, you see the numbers are not quite as strong. So Morgan Stanley have put out some research here, which shows that if you've had a positive year from January to November 3rd, then you've pretty much got a 75% chance that you're going to rally into year end. If, however, you have a negative year from January to November 3rd, then you see those probabilities shift in favor of a decline into year end 58% of the time. So that's quite a big shift from the seasonality that you would typically see in years that are not negative up till that point. Okay, so something we do need to be aware of. Now, other potential reasons why you might get that sell-off into year end is something we've discussed before, which is this tax loss selling after a bad year that could drive markets lower as people actually don't mind selling, kind of crystallize those losses to be able to make tax write-offs and things like that. We have talked about potential drivers for a year-end squeeze that could make us rally. The restarting of corporate buybacks, the CTAs looking very short right now, could be forced to cover those if the market rallies. But this was all stuff that was more likely when the market was above 3,900. Well, the corporate buybacks are still going to be and provide support for the market, but the CTAs probably don't get forced in until we pop our head above 4,000 even on the S&P. So just be aware of that. The Fed obviously is talking tough. We've got CPI later this week. So you would need that CPI to be a miss to the downside to trigger a bit of a knee-jerk rally to then get that CTA story going again. Okay, so we still see significant downside risk to risk assets. And looking at previous bear markets from this chart from tier one is for bear markets that have lasted longer than 200 days, like this one, on average, they haven't bottomed out for another 100 to 150 days. Right, so the chances are this thing does extend a bit if we look at past analogs, and then where this thing could bottom may be somewhere in the next 3 to 6 months, and the market's got another potential 15 to 20% lower if we look at what kind of happens on average in these bear markets going back to 1927. So bear market seasonality is a bit of a different beast to general market seasonality. That's the message that I want you to take away from that. All right, now let's go to the sort of trades that we're looking at and what's kind of caught my eye. So metals obviously squeezing on the China news, not that it's actually confirmed news, and actually they pushed back on it over the weekend saying that they're not changing their policies. This is the health officials, but the market doesn't really care. Chinese stocks, not only did they rally on Friday, they're up another 3% today. So they're clearly pushing that narrative a bit further. If we look at what the metals did, you can see here, silver and copper were leading the way. You then had zinc, platinum, iron ore, etc. If we look at what silver's done over the last month, so from the lows that it made in middle of October, it's outperforming copper and gold pretty significantly, right? It's up about 11-12%. Copper's up 5, gold's only up 1. So silver really sort of, taking the lead there. From our perspective, we do think the options market is presenting a nice hedging opportunity. For those of you who are long silver, like ourselves in the long-term portfolio, this is a trade we've done in the past. It's a trade we're looking to do again, which is a hedge, given that the vol dynamics kind of set up quite nicely for this. This thing's at the top Bollinger Band. It looks a bit overbought. It's kind of off the charts in terms of how overbought it is, given that sharp rally that we had. And we actually don't really buy into the China reopen narrative right now. We think it might be another one that's a false start. Yes, we agree it probably does happen at some point longer term, but we don't see a great reason to get so excited about it in the short term. So we actually quite like fading this, given the fact that we're long silver, given the fact that silver's rallied so sharply. We actually like fading this and putting on a little short-term tactical hedge against our silver holdings. And then on top of that, the silver gold ratio is at a key support level, which is making silver look overbought, at least on a short-term perspective as well. So we could well bounce in the silver gold ratio, which would then be a net negative for silver. And looking at the gold chart as well, it's right by this downtrend resistance level that it's rallied up to here. So this is kind of potentially going to fail at this level as well, I suspect. Okay, so what trade would I do? So that 5-year lows about 2 weeks ago. So upside calls in VIX seem to be offering some value for those of you brave enough to buy VIX. We talk in a bit more detail about what the skew's done on S&P, what's driving that sort of stuff. We personally, though, are not rushing to buy calls on the VIX because we do not want the setup where we're right about markets trading lower and yet we make no money on our hedges. Whilst you might get this right and the VIX might have a massive spike and go to 60 and you'll feel like a hero because you bought this at the lows, there is a risk that markets continue bleeding lower like they have been all year. And I don't want to be in a position where I put on a hedge that is supposed to make me money if the market goes down because I'm protecting the fact that I've got other longs that might lose me money. And if we end up dripping lower in the market over the next 2 months and I make no money off my hedge, I'm going to be very, very angry. So the way that I am expressing my bearish views on the S&P in terms of a hedge are I'm going to February 23, I'm selling call spreads. The options overlay portfolio, guys will know all about that because we did that trade last week. We're selling call spreads to finance puts in February 23. We like that setup. We take advantage of the skew setup, but the trade's got more delta on it. So we're more confident that in a lower market on the S&P, if we go there, we're more confident that will definitely have made us some money. And I feel much better about having a hedge like that in the book right now. All right, that's it for today. Thanks a lot for listening, everyone, and I'll catch you tomorrow.